The Federal Reserve is still seeing three rate cuts for 2024. It was a surprise to me. I thought maybe they would just take this outlook out of the table, but they're still seeing three rate cuts in 2024, but fewer rate cuts in 2025. Now, a lot of interesting things tend to happen after rate cuts. Some stocks do amazingly well. Sometimes we have a massive market crash after we have the first rate cut. I'm sure you've seen this chart. But in other times, we have a massive rally. And certain stocks do better than others, and other stocks, they tend to start underperforming. And this is what I'm going to discuss in the video. I'm going to discuss what kind of stocks I believe will outperform, what kind of stocks I believe will start underperforming, and what I believe will happen whenever the Fed starts cutting interest rates. Now, in terms of the performance in general, I know most of you will tell me, why do you even bother doing this video? Because all stocks will go up whenever the Fed cuts rates. Yes, you're right. But some stocks will do better than others. And we could also have more of a crash if the Fed does cut interest rates. This is a very interesting chart. It shows that what kind of performance the S&P 500 does after the first rate cut, whenever they first start cutting rates. We go up most of the time after a rate cut if we did not have a recession. But if you look at the red line and the light blue, whenever we had a recession, the stock market went down. And this is because the Fed was cutting rates for very good reasons, and because we had a bad economy, which means bad earnings, and everything was going down. So we will most likely have a rally in everything if we do have rate cuts and we don't have a recession. Now, this is a big thing. Are we going to have a recession or not? A lot of different indicators, like the 10-year minus the 3 months, they are flashing recession indicator. They've been accurate every single time. But something else that I've been seeing is the retail weakness. Ulta Beauty is facing weakness. Gucci is facing weakness. Nike is facing weakness. Even convenience stores like Circle K are facing weakness. Whenever weakness starts in retail, it starts to pick up in different parts of the economy. And that means the economy is cooling off, is getting a little bit weaker. It doesn't mean we're going to have a recession in 2024. It could be next year. But the retail being so weak is starting to get concerning for me. And this is something that I'm paying attention to. It tends to be a leading indicator within certain cyclical sectors of the stock market. So this is what I'm watching. So I'm not sure if we're going to have a recession or not, but I'm going to discuss the stocks that I believe will do best and the stocks that I believe will do worse. Now, this one will shock many of you, and most of you will disagree with me, because it's hard to agree with someone about something bad happening to a stock that we already own. Most people are long the Magnificent Sevens, and I think the Magnificent Sevens will start to underperform as soon as interest rates come down. As you know, they have had a massive outperformance relative to the S&P's other stocks in 2023, massive outperformance. I could not find the 2024, but in 2024, they started to cool off. And Russell 2000, a lot of the stocks that I own, are starting to pick up in a major way. As soon as in December, the Fed announced rate cuts, the Magnificent Sevens, they started underperforming, and a lot of the smaller cap, micro cap stocks, different sectors, they started to outperform the Magnificent Seven. And this is for very good reasons. And I believe the main reason that the Magnificent Seven have outperformed everything was mainly because of the higher interest rates, which causes a lot of investors to want to take on less risk. This is why the Russell 2000 has not made a new high yet. It should be sitting at all-time high. Normally, the Russell goes up much more than in the Nasdaq and the S&P 500, but this was not the case, and I've been buying the Russell. But the main reason investors were not betting on the Russell is because the Russell 2000, small caps, different industries, different smaller stocks, they are considered risky if we have higher interest rates. And once interest rates come down, a lot of institutional investors, they want to bet on the Russell 2000. This is why the Russell 2000 was up 147% from 2020 to 2021 to the peak, pretty close to the peak, whenever we had massive rate cuts. So whenever interest rates went up, a lot of the investors, they wanted to maybe speculate a little bit or to run for the safe companies, the big seven. This is why they're the Magnificent Seven. And they have a massive cash position. Google has over $110 billion of cash. Now, imagine that putting it in short-term treasuries, getting 5.5%. This is an extra $5 or $5.2 billion every single year in just interest. Same thing with Microsoft, $80 billion. Apple, like $65 billion. Amazon, something like $90 billion or $85 billion. And these have massive cash positions. And as soon as the Fed started announcing rate cuts in December, what happened? The Russell 2000 started bottoming out, Russell 2000 started going up, and a lot of the Magnificent Seven stocks, some of them are rallying, of course, but a lot of them have started to underperform. So I believe the Magnificent Seven stocks, as soon as interest rates start coming down. It does not mean they're going to crash. It doesn't mean they're not going to continue going up. But I don't believe they will outperform as much as they did. And it's mainly because of higher interest rates. Interest rates come down. A lot of the investors, they would like to speculate on different sectors, different industries, smaller cap, micro caps, REITs, and many different areas that I'm going to discuss in the video. So I believe the Magnificent Seven's outperformance will likely end as soon as we start having rate cuts. Now, the first one that will benefit massively within rate cuts, and it might surprise some of you, but is mainly companies with very high debt. Companies like Warner Brothers Discovery. This is the 10-year bond versus Warner Brothers. Warner Brothers is in the white, and the 10-year bond is in the orange. And this is not the yield, this is the bond itself. So once the bond is going up, yields are coming down. And as you can see, once the bond was going up, yields were coming down, WBD rallied. Whenever the bond, which is the orange, started coming down, yields started going up, WBD has been selling off. And this is a chart of the correlation for the 10-year and Warner Brothers Discovery. And as you can see, most of the time, they had an extremely positive correlation. It's the same thing with high debt companies like MPW. A lot of these companies that have very high debt, they will likely benefit massively from lower interest rates, as a lot of institutional investors will consider them less risky. It's not just if they have a good balance sheet or not. Like WBD's debt is 100% fixed at 4.6% interest rates with very much widespread maturities. So it's nothing major in the short term, and 4.6% 100% fixed interest. But yet WBD is still correlating. So this is what I want you to understand in the video, that it's not just about the single specific company. A lot of the time, algorithms are programmed in a certain way to treat all stocks the same. For example, in the Russell, you might have a lot of amazing companies, but if this is a risk-off rally, they don't want to take risk, and they would like to be more safe in Nvidia and Apple and Google than the small caps because interest rates are high, then all these stocks are going to underperform. And it's the same thing on the opposite direction. A lot of the junk companies that are not worth anything, they will outperform like they did in 2020, 2021 if we are having lower interest rates. So the first category of stocks that will benefit is pretty much any company that has some kind of interest rates problem or debt problem, especially MPW. MPW made a massive rally in November, December. Whenever we had this whole thing about interest rates, it went from $7 to $10, and then the whole thing faded, and then it went to $4. So a lot of these stocks are just correlated based off the 10-year and how interest rates will likely look like. The second one that I believe will benefit massively is mainly the gold and gold mining stocks. You might say, what do you mean? If we have lower inflation, gold will underperform because gold is an inflation hedge. And this is not how institutional investors have been treating gold. If you remember in 2022, we had record high inflation. What happened? Gold crashed. Why did gold crash? Because the Fed was hiking interest rates. Gold is not what it used to be. Same thing with Bitcoin. You believe Bitcoin is an inflation hedge? It's not. As soon as interest rates were going up, Bitcoin and gold together, they underperformed when they should have been outperforming. We have higher inflation, but it was mainly because the Fed was raising rates. So in a lower rate environment, gold will perform amazingly well, especially the gold miners. The gold miners should be trading. I mean, they always made a new high together. So GDX and gold, they did that in 2020. And now gold is sitting pretty close to an all-time high. The GDX and most miners and even royalty companies like Franco-Nevada, Sandstorm, and many others, they're nowhere close to an all-time high. So I see 50, 60, 70, 80% upside on a lot of these stocks if the whole thing, plays out in terms of lower interest rates, better risk appetite, money comes out of the Magnificent Seven, it starts going in many different stocks. So one of them is the gold miners, and I believe they will do amazingly well. Same thing with Russell 2000. The Russell 2000 is nowhere close to an all-time high. So Russell tends to outperform the Nasdaq and the S&P. So whenever the Nasdaq and S&P makes a new high, Russell normally makes a new high. But this has not been the case. And yes, it has been performing amazingly well, and it broke out of a pre-channel and is starting to show some strength. But I believe this is only the beginning. And I think there's massive upside for Russell 2000 stocks and many stocks, smaller caps and micro caps. Another ones that I believe have pretty decent upside is any company that has a high dividend yield, like something like Pfizer, for example. Pfizer is, you could look at this chart, has been beaten down a lot. And I believe the dividend for Pfizer is safe. So the dividend is around 6%. And I did a video on Pfizer. but for a 6% dividend, the company is paying around $9.2 billion every single year in dividends. $9.2 billion. And the free cash flow in 2024 is around $10.1 billion. So it's barely covering it, but it's still covering it within $1 billion. And after 2024, free cash flow should pick up to 16 billion, 17 billion, 19 billion to recover to where it should have been after 2020, but they had a massive bump whenever they had the COVID vaccines, and things came down and it's starting to recover, so it's on its way. And the CEO did mention of how important the dividend is to them and have a good balance sheet for them to maintain the dividend. So I believe the 6% dividend for Pfizer is safe. They do have some debt maturing, of course, around $3.7 billion in 2025, $6 billion in 2026, and $1 billion in 2027. And the company already has $10 billion of cash. So I think the 6% dividend for Pfizer is safe. Same thing for Bristol Myers. They also has like a 5.5% dividend. So any company with a 5% plus dividend, I believe will do amazingly well in an environment when we have lower interest rates. Now, a lot of you guys asked me about AEP or other stocks like American Electric Power and many of the, what do you call them, utilities. But for me, I'm not a big fan of utilities. I mean, yes, utilities are not bad, but I would never buy utilities at a discount. If I could buy REITs at a discount, I think REITs are much better valued than utilities, much more stable, a little bit lower debt, of course. They operate on large debt in terms of utilities, but I really like REITs. Like Realty Income is still down 26% over the last 5 years. VC is up 31%. Triple Net is down 23%. Agree Realty is down 19.5% over the last 5 years. These stocks have done nothing. They should be trading at new highs, but this is not happening because of higher interest rates. So once interest rates start coming down, a lot of the REITs are going to play out. For me, my personal favorites are stocks like Pfizer, any stock with a high dividend, the gold mining stocks and gold stocks, and mainly the Russell 2000. I think there's so much potential for the Russell 2000, but it will all depend on if we will have a recession or not in 2024 or in 2025. And I'm not really sure what's going to happen, but these are the stocks that I believe will underperform and outperform if we do have a rate cut coming very soon. And I hope to come back to this video and see if I was right or if I was wrong and just see what happened and update you guys on my thoughts. So thank you for watching the video. It was not financial advice. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.